I just got denied credit with a 780 FICO score from Alliant Federal Credit Union. Have you ever been denied a credit card with a perfect credit score? This one is for you. We got to talk about why having a mortgage is so important for your credit profile, why an 18% utilization rate isn't good enough to get approved sometimes, and why bank and FICO scoring company employees say you can still get denied even with an 850 credit score. As someone who's obsessed with the world of business and personal credit, I'm always on the lookout for banks and credit unions that offer soft pull pre-approvals. Why? Because these gems can show you where you stand without the risk of a hard inquiry hitting your credit report. It's like peeking behind the curtain before stepping on the stage. Last month, I stumbled upon something promising. Alliant Credit Union had a credit card pre-qualification tool. My curiosity lit up immediately. What better way to test the waters and share the experience with all of you than by trying it for myself? So I decided to pull the trigger. I filled out my personal details, double checked for accuracy, and then hit submit. You know, there's always that moment, isn't there? The anticipation after you click submit. It's brief, but your mind races through all the scenarios, each one filled with its own what ifs. Now, a few minutes later, my email notification went off. I was like, that's a quick response. That could be a good sign. But when I opened the email, there it was, a denial. It's never exactly fun to see the word denied, even if you're prepared for it. But here's the thing. It didn't affect my score at all. It was a soft pull, so no harm done. I remind myself that this was part of the experiment, part of the journey. Yet what came next kind of surprised me even more. I was surprised to see that Alliant had sent me a detailed response letter, the kind that you typically receive after a full application. This denial wasn't just a simple no, it included specific feedback based on my credit report, including my TransUnion FICO score of 780, and highlighted the areas where my profile fell short. It felt like being handed a roadmap showing the hurdles I needed to overcome for future approval. So instead of feeling defeated, I saw it as a gift. This wasn't just thanks but no thanks. It was a chance to learn, adjust, and prepare. Now I could pinpoint my flaws and then work on them before deciding to go all in with a full application. And coming up, I'll show you the reasons they denied me and how I can go about correcting those deficiencies before I fully apply. But before we get there, if you want to see every other credit union that will pre-qualify you without a hard credit pull, just like this one does, then you gotta hit the link below and get instant access to my free credit card pre-approval master list. It has over 60 cards to choose from right now. Now, reason number one was because of membership tenure too short. I couldn't help but let out a frustrated sigh. I had never had an account with Alliant Credit Union in my life, so it felt like they were holding an invisible standard against me, one I hadn't even had a chance to meet. But here's why this matters the most and what you need to know if you're in a similar position. Credit unions, especially smaller ones like Alliant, prioritize building long-term relationships over quick wins, which makes sense when you consider their focus on community and trust. Unlike the big national banks, credit unions often lean on the length of membership as an indicator of reliability. It's not just about your credit score, it's about your history with them. Have you shown consistency? Are you loyal or just passing through? That's what they're thinking when they look at a new applicant. And here's the kicker. Living in North Carolina, I'm miles away from Alliance headquarters in Chicago. I can't just walk into a branch, shake a hand with a teller and open an account like a local member might. The traditional route to building that relationship isn't available to me. And for many of you out there as well, it might not be an option. But where there's a will, there's a workaround. There is an answer for this. You can establish a connection with Alliant that sets the stage for trust. Start by opening a checking or savings account, but don't stop there. Make small deposits, set up automated transactions, and let those accounts show activity for 30 to 90 days. This is your way of saying, hey, I'm here to stay. But you might be wondering, how do I even join Alliant if I'm not local? That's where the digital path opens up. You can become eligible for Alliant Credit Union membership through their partnership with the Alliant Credit Union Foundation. And here's the best part. You don't need to make a huge deposit to become a member. Alliant will make a one-time $5 donation on your behalf to that foundation, granting you access to their credit union. And just like that, you're in. The second reason they denied me was no open real estate secured loans in my credit file. Lenders see a mortgage as more than just another debt on your profile. They see it as proof of stability and reliability. When they review your credit applications, a mortgage tells them a story of consistency and your ability to manage substantial debt over many years. It's also a sign of financial maturity and a key element of what lenders consider a strong, diverse credit profile. According to the FICO scoring company, high achievers, those with top tier credit scores typically have an average of 5 installment accounts. This is no accident. It's because a diverse credit mix, one that includes loans like mortgages and revolving accounts like credit cards, they demonstrate your capacity to handle various types of credit responsibly. Now, here's where my story takes a twist. I actually do have a mortgage and I've been paying on it like clockwork. Here's the problem though. My mortgage was recently sold to a new lender, a process known as mortgage servicing transfer. While this is common in the lending world, it comes with an unexpected hitch. The new lender won't report my mortgage to the credit bureaus for 60 days. So despite my consistent payments, my credit report right now looks as if I don't have a mortgage at all. It's frustrating to know that I'm not getting credit for those on-time payments, which could be the difference between approval and denial for new credit. The good news is this issue has a built-in expiration date. I can wait another month or so for my new lender to start reporting to the credit bureaus before I submit any new credit card applications. Now, in the meantime, I'm monitoring my TransUnion report like a hawk through Credit Karma, ready to act as soon as that mortgage reappears. Now, I'm fully aware that not everyone seeing this video even has the option to leverage a mortgage for their credit profile. If you're renting right now, don't worry. There are still ways to build a diverse credit mix that signals financial stability to lenders. One, you could use a pledge loan or secured loan. Check with your bank or credit union for a secured loan, which acts as an installment loan and can boost your credit mix. You can even go for a personal loan. This can serve as another type of installment loan, helping to diversify your credit profile. Another good one is an installment loan from Kovo. It's an easy way to show that you can manage long-term payments. And you even have rent reporting services, like BoomPay. If you go with them, you can report your on-time rent payments to the credit bureaus, which can bolster your credit profile similar to a mortgage would. Now, reason number 3 was too many bank cards with high balances. Lenders want to know that you can handle your existing credit before they even offer more. And a stack of cards with high balances makes them wonder if you're overextended or relying too much on borrowed money. This can quickly turn into a risk factor that impacts your credit decisions. FICO scores weigh both your total utilization across all cards and the utilization rate on each individual card. So while you might think that spreading debt across multiple cards is smart, if those cards are carrying high balances, it paints a different picture. It tells lenders that you might be at risk of struggling to manage your additional debt. And recently, I signed up for a new 0% APR credit card to help fund some new renovations for my home. But it came with consequences. One of my cards is currently maxed out at 100% utilization, while another sits at 79% temporarily. In the eyes of a lender, this can look like a flashing warning sign, suggesting that I might be using too much of my available credit and that I could struggle with future payments. This kind of profile will almost certainly spook most lenders when they analyze a credit report. Even with an otherwise excellent credit score, high utilization can really outweigh other positive factors and lead to denials or less favorable terms. The solution for me and for anyone in a similar situation is to pay down those high utilization cards as quickly as possible, aiming to get that usage rate below 10%. This approach not only eases the concerns of lenders, but also positively impacts your credit score. But what if paying down your debt directly isn't possible? A practical option is using a personal or debt consolidation loan. This strategy is widely accepted in the credit industry, and it gives you multiple benefits. It dramatically lowers your utilization rate. By moving credit card debt to an installment loan, you instantly reduce your revolving utilization, which then boosts up your credit profile. And then it improves your credit mix. Lenders really appreciate seeing a mix of credit types, and an installment loan diversifies your credit profile in that way. It also lowers your overall interest expense. Personal loans often come with lower interest rates compared to credit cards, so this move will save you money over time. And then reason number 4 was high proportion of balances from existing bank cards. When lenders evaluate your credit application, they really zero in on credit utilization, the percentage of available credit you're using at any given time. Credit utilization is one of the key indicators lenders use to gauge risk. For FICO score high achievers, the average utilization rate is below 7%. This benchmark tells lenders that these people are using small amounts of their credit, paying down their balances, and avoiding excessive debt. But I disagree with the Lion on this one. I don't think this is a major problem for me personally. My total credit utilization is a reasonable 18%, and that's well below the commonly recommended 30% threshold. People can easily get approved for credit with utilization at that level. So why was it listed as a reason for my recent credit denial? I think it's linked to the fact that a couple of my individual cards currently have high balances, which can still be concerning for lenders, even if your overall utilization looks good. Lenders don't just look at the big picture, they also zoom in on each account. Even if a few of your cards are maxed out or carrying a significant balance, it can cast a shadow over your entire credit report, even if your total utilization is technically acceptable. Now, to solve this problem, my focus is going to be lowering my balances on my high utilization cards. So moving on, understanding how banks review your credit report can make all the difference in avoiding unexpected denials or credit reductions. While your credit score is crucial, banks often dig even deeper into specific report details before making a final decision. And here's what a US Bank Solutions supervisor said. It said, even with a good score, certain credit report details like recent hard credit pulls or high balances can trigger stricter credit decisions or limit increases. To me, this highlights that banks look beyond the number and analyze patterns in your credit behavior. And even a credit card company underwriter emphasized that banks have internal criteria that can flag risk like high utilization rates and multiple accounts with balances. They stated that underwriting often flags high utilization rates and high number of open accounts with balances as potential risks, leading to automatic declines or tighter credit terms. And then a couple of FICO scoring experts chimed in as well during their interview. One of them was a senior product manager and another was a vice president of scores. They explained that while a credit score provides a summary, banks rely on the detailed credit report for decision making. One of them even said banks use the raw data from credit reports such as recent inquiries, high revolving credit usage, and absent of installment loans as primary decision points beyond just the score. Another FICO scoring expert noted that specific patterns such as high credit utilization and recent credit seeking behavior can lead banks to make what they refer to as hard cuts. He said high credit utilization and a pattern of recent credit seeking, and those are just decisions to deny or reduce your credit regardless of your overall credit score. And listen, this was just the tip of the iceberg when it comes to FICO scoring company secrets. I found an interview where 4 FICO scoring company managers with decades of experience gave credit hacks on raising your credit scores and shared secrets about how the FICO scoring model really works. You got to check out the next video to see how your credit scores are calculated and why sometimes things just don't make sense. Thank you for watching.